speaker for today is Joseph Wiggins. He is going to be talking to you about reverse mortgages and reverse purchases. I'm so excited to turn the floor over to him. Just to let you know that I have been knowing this guy for a little while now. I have a lot of respect for him. He is a professional in the industry. I have done countless loans with him. I've counseled with him about different products and services that are available. And I'm just mentioning this to you because I would not have someone come on the line to give you a presentation that I didn't trust, number one, or that I hadn't already done business with. So I trust him wholeheartedly, and that is why he's here. He is considered an expert in the industry. Without further ado, Joe, take us away.
Thanks for that amazing intro. And I just want to say that when we first started talking about doing this, this is for the participants here, where Morris and Shereece came from, everyone at the Shereece Monroe group came from a place of really caring. And so in my chair, that's just always super refreshing. You can't fake being genuine, right? And I just want to say thank you guys for allowing me to be here and for carrying that spirit of education forward, because that's what we're here to do, right? And so I'm happy to be here. I'll go ahead and share my screen, make sure I don't mess that up, and we can start. All right, can everybody see my screen okay? Thumbs up if you can see it.
Very good.
Awesome, great. So like Shereece said, I've been doing loans for a long time. This is my 30th year in the business. I started doing reverse mortgages about 20 years ago, and I can tell you hands down, they're the most satisfying loan programs that we can do as mortgage people. And the reason for that is they have the ability to really change people's lives and the trajectory of their lives in retirement. And so I want to start, I've got some information, and I think the Q&A part will be extremely valuable for everybody. But I wanted to start with a story about one of my favorite customers that we helped with a reverse about 15 years ago. His name was Roy. He actually came into, I had an office in Riverside, California at the time. He came into the office, he was very, very short, very direct. And he said, listen, Joe, I need a 10-year fixed loan at a 2% interest rate. Actually, I think it was like 1.5% interest rate. And I said, Roy, I'd love to give that to you, but it's a unicorn, it doesn't exist. And so I started talking with Roy, learned more about his situation, and he had devised the terms because he was only bringing in about $950 a month in retirement income. His entire retirement was a very small Social Security amount. And his current mortgage payment was $900 of that every month. And he was trying to get that down by another $50 so he'd have a whole $100 to live on every month. So when I met Roy, he couldn't put more than a quarter tank of gas in his truck because the tank had a hole in it and he couldn't afford to fix it. I honestly have no idea how he was living or how he was surviving. Long story short, the thing that Roy did have was a house that was almost free and clear. He owed about $25,000 on it. And it was worth about $600,000. So long story short, we were able to help Roy take advantage of that. He netted out about $100,000. That's what he wanted. The reverse mortgage product at that time was a little bit different than it is now. He used that to purchase a new vehicle, get rid of the old truck. And then he also set it up to where the reverse paid him an additional $1,500 a month. And so for Roy, he was able to eliminate his mortgage payment. He continues to pay his taxes and insurance, which is a requirement of the reverse. And so for Roy, it was a $2,400 a month switch. And to say he wasn't the happiest guy I ever met after that closed would be an understatement. And as long as we had that office there, we were there for about 6 years. He would bring us stuff every Christmas. We would bring things to his house as well. So when I say they're the most rewarding loans, I'm not kidding. So let's get into it. And we'll go through what you're going to learn today, the basics of a reverse. The technical term for a reverse is a HECM, or a home equity conversion mortgage. That's just a fancy way of saying reverse mortgage that is backed by FHA and HUD. We'll kind of go through a couple of different solutions to some challenges I think that retirees are facing right now. And then we'll cut through some actual real world examples and bust a few myths in the process. And then of course, we'll have the Q&A. So some of these I'm just going to gloss over. We all kind of know the baby boomer stats, and there's plenty of stats you can check out right here. But the one I want to key in on is the last one. And a lot of times, when we talk to seniors about a reverse and we go through the education process with them and a consultation, they feel like they're kind of an outlier, that not many people do these and that they're like a last resort or something of that nature. And that couldn't be further from the truth. And that last statistic really outlines this. And it's that the largest reverse mortgage servicer in the country right now receives over 47,000 requests for information every month. So what that tells me is it's becoming more and more mainstream and something that a lot of financial advisors now are even recommending for somebody's retirement package. So we'll get into it. The HECM basics, it's insured by FHA. You've got to be 62 years of age or older. You could have a spouse that's younger as long as one of you is 62 or older. They've put some recent protections in place that protects what they call a non-borrowing spouse, which they previously didn't have. And right now, the reverse mortgage product is the safest and most reliable it's ever been. And a lot of times we think, this program's been around forever. It really hasn't. It really came out in the late 70s, early 80s. And so it's relatively new if you look at it from that perspective. But I can tell you what's nice is it's a way to tap equity. There's the piggy bank there without increasing your outgo. In fact, the number one reason why most people do a reverse mortgage is to eliminate their principal and interest mortgage payment. That in and of itself is usually a game changer. And like Morris had indicated, like Shereece had mentioned as well, you can use the reverse mortgage to also purchase a home. And so we'll get into some of the details here. 62 or older, must own the home. It needs to be a primary residence and have about 50% equity or more. So the more equity you have, the better it can be, and the more options that you have essentially. There is a financial assessment, but it's nowhere near the same as if you were getting like a forward mortgage. And the assessment is really designed to make sure that you have enough static, consistent income coming in to take care of your ancillary debt. So maybe if you have a vehicle or credit cards, as well as your homeowner's insurance policy on your house and the property tax. Those are the biggies. So a lot of people think you've got to have great credit scores and all this other stuff, and you don't. So FICO scores do not matter. There's no debt to income ratio requirements and no reserves are required. So the thing I like is HUD has really taken a real world look at this and said, you know what, we're really trying to help people that could benefit most from this program. So a common question is, what types of properties can we use for a reverse? And the answer to that is if we can do FHA financing on it for a forward mortgage, we can also do it for a reverse. And that would include SFR, which is just single family residence, existing, new construction, or new construction, as well as condos, as long as the condo is FHA approved, and also manufactured homes on permanent foundation. So there's a lot of different property types that we can do for a reverse. Like I mentioned, the biggest reason that most people do them is to eliminate their current principal and interest mortgage payment, which is usually by far their biggest debt, sometimes their only debt. And so it's a great way to, number one, pay off your current mortgage and eliminate the mortgage payment, which obviously increases the cash flow. And as everybody knows right now on a fixed income, the more cash flow, the better, right? And so it's a way to take advantage of your equity to improve your overall financial situation. So some of the challenges, as we know, if you can delay tapping a pension or Social Security for longer, typically that means that is going to be a larger amount that you're going to receive. And so doing a reverse to free up cash flow now is a way that you could delay that and therefore improve your future retirement outlook. You can also postpone drawing down on your market account. So there's quite a few financial advisors. I subscribe to a few monthly newsletters myself, and a lot of them are pointed at seniors, and they're saying, hey, look, if a majority of your pension or your retirement is tied up in a 401k, you might want to look at alternatives to tapping that and allow that 401k to recover and, let your portfolio recover in kind of a down market as far as the stock market's concerned. Again, cash flow is a big challenge for anyone on a fixed income, especially with inflation. So in my opinion, the people that we talk to now have more of a need than even a year or two ago. And it's kind of the perfect storm because one of the biggest pieces in a reverse is equity. And right now, house values are very strong. Inventory is limited. I know Shereece and the Monroe Group are experts on all of these things, and I'm sure that they would agree that values are near all-time highs right now, but it may not always be like that, right? And so when you're doing something like a reverse, the value is hypercritical, and the higher the value, the more benefit that you could have. And so the timing to be looking at one of these is excellent as a result. The last thing I'll touch on, and I'll go into a little bit more later, is that you can also get a line of credit if you have enough equity to do so. What's nice about the line of credit is it can allow you to replace your cash reserves. It's non-cancelable and you don't have to use it. If you do use it, there's no payment required. So it's pretty cool. So a lot of times, costs of mortgage, a common question is, what is this going to cost? How do the costs compare? Maybe you've heard different things like reverse mortgages are more expensive than other loan products. And this is literally a side-by-side comparison of a reverse mortgage to a forward conventional mortgage to a forward FHA. And what you'll see there at the total loan fees, the bottom line is that the fees are about the same. So the myth that fees are a lot higher on reverse mortgages simply isn't true when you're working with us, and I would say with most companies right now. So let's talk more about the line of credit, because a lot of times people will say, hey, Joe, I like the idea of being able to tap my equity, but I don't necessarily need it right now. And so you could look at this as just a giant reserve account that you have access to. The great part about it is that they can't cancel it. There's a lot of people right now doing traditional lines of credit or HELOCs. The problem with that is if the market turns south and values drop beyond a certain threshold, what do the banks do? They start canceling those lines because they don't want to be upside down on a house, right? With this product, they can't do that. And what's really cool is if you don't use the line, it continues to grow every year. And so I've got an illustration here that points that out, and specifically here. So if somebody had a line of credit in the beginning of $285,713, if they didn't touch that line for 5 years, it would grow to $382,000, $328,000. And that growth happens regardless of what the values do. So you could literally do this reverse mortgage as it's set here. Values could tank. Not that they will, they could, and you're unscathed with an uncancelable growing line of credit. Very powerful. One of the things you could use that line for, and I know Shereece, I think you're doing some exciting stuff that I know you'll share with the group here, maybe on a later call, but there you can make investments. And so we have some seniors that are using that line of credit, since you can pay it off if you like, there's no prepayment penalty on it, to buy other real estate, or maybe flip other real estate, or invest in other things, or a second home, let's say in Punta Cana, for example, right? So a couple of real world examples. This is Rosie, very, very nice lady that we met late last year. We just closed her reverse mortgage refinance in December of last year. And so before we met her. She was making $23.07 a month. That was a small pension from Target, and the rest was Social Security. Her mortgage payment was $675 a month, and she had about $1,500 a month discretionary to live on every month. And what Rosie was feeling is what we're all kind of feeling, is that the strangle of inflation, right? So the grocery store trip that once cost $50 for Rosie was now closer to $100. And when you're on a fixed income, that's scary, right? It gets scary. It gets scary for me. I'm not on a fixed income yet. So after she did the reverse, she was able to completely pay off her current mortgage, which eliminated that $675 a month, and it increased her cash flow by 30%, up to $21.75 per month. And more than that, it gave her a ton of breathing room. Here's a specific screenshot of a proposal that we had done for Rosie, so you can kind of get a feel for what that might look like if you're trying to do a discovery on something like this. Her home was valued at $400,000. Based on her age, they would allow her principal limit to be up to $173,200. She owed $153,000 on the house, so we were able to pay that, cover all of the costs, and still net her out approximately $3,800 at closing. And in doing so, again, she was able to completely eliminate her principal and interest payment. So next example is Ron and Sue, and this ties into the purchase that Morris and Shereece mentioned. And this is a great example because these folks were already kind of living the dream. And when you have as much equity as I'm sure most of you on the call have, it's a great feeling, but it's one that's not necessarily permanent unless you act on it, right? And so Ron and Sue, they're up in Northern California, $6,900 a month in pension income between the two of them. Their mortgage payment was $2,200 a month, which I think fits a lot of our profiles here on the call as well. And then they had other debt totaling $902 a month. So after they were able to sell their house, buy their dream home, which was brand new, they used a reverse mortgage to do it. They took some of their net and completely cleared their debt load. And at the same time, because they did a reverse purchase, there's no monthly principal and interest payment on that new mortgage. So they literally increased their cash flow by $3,100 a month. And at the same time, were able to move into their dream home, which is a Four Seasons neighborhood. Like, I'm so jealous of Ron and Sue because they are living the golf cart dream right now. So they send me picture text messages of their lifestyle. And I think they're home maybe twice a week because they're going, riding their golf carts to their neighbor's house and having dinner and that sort of thing. And so this is what it looked like for Ron and Sue in more of a proposal format. What you'll see is the sales price of their home was $708,000, or purchase price rather. They brought in $426,000 cash to close, and that enabled them to not have a principal and interest payment. And I highlighted here year 5 because I want to bring up a good point, which is you can predict with certainty what your reverse mortgage balance is going to grow to at the end of any given year. And I wanted to reiterate that if Ron and Sue decided that they no longer wanted to live in that home, they could, for example, sell it in year 5. Their balance would have grown to 408, but they paid 708. I'd got to imagine the places would probably be worth at least 800 or so by then. They're going to net the difference. So it works the same way as if you didn't have a reverse on your existing home. You're still going to have a net gain on sale, and you can do that, do with that what you wish. Do another reverse purchase or whatever. And so just looking back, the HECM basics, I tried to keep it to where it's not really confusing, and I know I'm talking a lot, so hopefully that was the case. The big thing here, guys, is there are a lot of challenges, I think, that people on fixed incomes are facing right now. And what's exciting is the product has never been safer than it is right now. There's a lot of education that is required before you can even apply for something like this. And it's just, it can be a great tool if you know how to use it and if you set it up correctly. And so with that, I'll stop sharing and we can get into the Q&As.